Our first speaker for today is David Roberts, Portfolio Manager at Palomar Fixed Income, who managed the Nedgroup Investments Global Strategic Bond Fund. The fund is an unlevered core global bond portfolio focusing on liquidity, interest rate, and credit risk, while avoiding currency risk and illiquid, lower quality or ESG risk exposed bonds. Hi, David. How have you been?
Very good. Yeah. Thank you.
Had a good New Year celebration and things?
Yeah, that was a bit quiet. All my family birthdays seem to be in December. So by the time we get to New Year, you just want to have a nice quiet evening, which is what we did. Yeah.
Yeah, brilliant. Well, all of the best to you and the family and the team for the year ahead.
Thank you. And the same to you and everyone in South Africa.
Great, thanks. So Dave, I wanted to take this opportunity to delve into the portfolio a little bit more, please. So I know there's a lot of our clients here very interested to hear from you. Shall we kick off?
That would be great. Good place to start.
Okay, brilliant. So Dave, there have been so many market-moving events during the course of last year. Can you please talk us through some of the fund returns specifically and what actually drove those returns, please?
Yeah, that's a really good place to start. As I say, the first thing to note, your point, is markets were volatile. However, if we go right back to the beginning, what we had guided for the year was total returns of maybe 4 or 5%, that kind of area. Now, we didn't launch the fund until the 9th of January, but by year end, after fees, we were just under 5% at 4.92 for total return. So the overall year didn't seem too unusual, but exactly as you say, within the year there was quite a lot of volatility. The way I would characterize that really was that bond investors, bond markets, economists and strategists were wrong 2 or 3 times. They expected interest rates to go up, then to come down, and then as we saw Mr. Trump elected, a worry that rates would stay higher and we would see inflation. But if you bring all that together, then from our perspective, it was still possible to post returns, as I say, after fees of close to 5%. So again, the majority of those returns really from the core of the bond market, which is delivering income. So we started with a yield on our portfolio of about 5%. That's about what we returned in total. So capital values didn't really move that much.
Great, thanks. And I mean, as you mentioned, Trump has been making the news in a big way. You know, market expectations of central bank actions has had quite a big impact as well. So what kind of scenarios are you planning for the year ahead? And what kind of returns are you expecting as well, please?
Well, that's a good question. Again, there are really for us 3 major parts to the market. There are developed market sovereign bonds, developed market credit, so corporate debt, and a little bit of high yield. And then the third part is China. China for us is an interesting one. Our mandate doesn't allow us to buy local currency Chinese debt. So if you strip that out of our index, we would actually have outperformed in the fourth quarter. So, but I just leave that to one side. So what we're really talking about is, our outlook and expectation for G7, more or less, sovereign and corporate debt. Now, on the sovereign side, the impact of Mr. Trump coming in has been to worry bond markets. The suggestion about tariffs, about trade barriers, about deglobalization, about anti-immigrant policies, all creating a concern that we would see sticky inflation and perhaps less growth than people were hoping for, although obviously the Republican Party would argue that it is a growth positive agenda. But the impact of that has been to see bond yields move higher. Now, our view is that there is a little bit too much of that bad news, that pro-inflation news priced into markets. And indeed, interest rate markets are now pricing for less in terms of interest rate cuts than most central banks are suggesting. If you roll all that together, we would say that the core expectation from our side is that, again, most of the returns will be driven by income, but we could see a small degree of positive capital gain. The core from our perspective in terms of total return really would be in that kind of 5 to 8% range. The possibility that we do better than that, maybe low double digits. We would ascribe a probability of maybe about 0.2, so about 20% to that. But the flip side is if we do see some very aggressive policies from the US and that then spreads out to the rest of the world, there could be a little bit of downside risk. But in aggregate, we would expect positive mid-single digits, and in terms of total return, maybe just slightly better than we have seen this year as the market settles down and starts to realise we're not going into a significant reflationary phase in 2025.
Okay, wow, that's quite interesting. I mean, you actually mentioned so many interesting points there. And Dave, if you had to pull it all together, just in terms of positioning of the portfolio, I mean, I know that there's many clients dialing in today who absolutely love all these technical details. So if you can, please spend a bit of time on how you've positioned the portfolio and the details, please, before we close off for today.
I think you're right. This is normally when we start a year, or when I've started a year, and I've been doing this for 30, 35 years, you do have a very good sense of the overall direction of markets. Certainly in bonds, you can say with a high degree of confidence, yields will go up, yields will go down, prices will rise, prices will fall. I would say that there is quite a high degree of uncertainty around this year. However, we are value-driven investors, and when we see yields rise and prices fall to levels that we think are not really justified, then we will act. So in terms of positioning then, we have increased our interest rate exposure, our duration, from about 5.5 years, a year, 2 months ago maybe, to closer to 6.5 years now. So we've taken more interest rate risk, which means that if we are correct and the market settles down, perhaps rallies, then that would benefit investors. So that's on the government side. Most of the G7 markets are similar in terms of value, to be honest. They'll either rise or they'll fall together. Japan being the exception. We still own no Japanese bonds, and it's quite possible by the time people watch this video that Japan might actually have raised interest rates. So we're quite happy to avoid that market. And then in the corporate bond side, that's a market that's quite expensive. It tends to be highly correlated with equities, as you know. So we're not overly nervous, but we're just taking a slightly more defensive position there. The overall weight that we have to corporate bonds has come down slightly, but really what we've done is we've shortened the maturity to create more protection for investors if the market does sell off a little bit, and then at the same time give us the scope, the opportunity to buy some of that risk back if, as I say, as a value-driven investor, we see a better price entry point. So just to sum that up, core from our perspective, similar returns may be slightly higher in 2025, but the dispersion of probability is greater. So the tail risks that people talk about have increased both to the up and downside for investors. But we continue to position the portfolio to capture some positive total return and also have enough scope within the mandate to increase the risk should we see prices fall, partly as Mr. Trump comes into office.
Dave, thanks so much. I mean, the fund, as you mentioned, was launched early last year, and we've already gone through $100 million. So congratulations on that. And yeah, looking forward to many good returns for the years ahead.
Thank you. Obviously, we couldn't have done that without the support of Nedgroup, and it is great to be part of the organization.
Well, great having you on the team. Thanks, Dave. We'll see you soon.
Thank you.